VIX is a really good tool to understand, and it has some very key points of our economic past that has led to some historical data that continues to repeat itself every maybe 4 to 5 years. In the markets, we want to stay at a steady pace, and if we start to see the VIX measure above a particular level, there's probably something coming or happening that you may not be informed of, but someone else is, and they're making moves behind the scenes, which is causing this irregular heartbeat that might trickle into something that would lead to intensity. We're going to lay out some of the tools of war in this video. So specifically, this video is going to be about the VIX. And even if you aren't a trader, you might find this topic very, very interesting. So in the stock market, we have a lot of different measurements of economic data that leads to price movements in our economy, right? So allow me to speak from a chaotic mind, right? There is definitely an art to war. So first, you get an outline, and then you get the colors, right? So in this particular situation, I have a chart here with the VIX, and it has some very key points of our economic past that has led to some historical data that continues to repeat itself every maybe 4 to 5 years. So one of the conclusions that it led me to was wondering if some of these events are kind of premeditated in order to cause move or scarcities in the market by some big leaders, right? So in the previous videos, we talked about psychological operations, and this is one of the instruments that kind of gives me that feeling and example. So on this VIX chart here that will be displayed, you can see we start off with the dot-com bubble, right? It starts from about 2000 all the way to current day, right? Or on this chart, 2018. So we have the dot-com bubble, September 11 attacks, the Iraq wars, 2008 global crisis. These are all events along this VIX chart. So the main key point that we want to drive here is the VIX is a volatility index, right? Volatility index. So volatility is how much fluctuation happens in the market. So when we talk about volatility in the market, it's like how many shares are being passed between traders, right? So in regular economic situations, you'll have kind of like a regular heartbeat, right? So the chart is supposed to be measured in a very average scenario. But as your heart rate starts to increase, you know something is happening, right? So let's bring this down to a personal level before we go to the economy. So let's say you go to the gym and you haven't started your workout. Your heart rate should be pretty regular. But if you're doing something like cardio or something very intense, your heart rate's probably irregular, right? Very volatile. So in the markets, we want to stay at a steady pace. And if we start to see the VIX measure above a particular level, there's probably something coming or happening that you may not be informed of, but someone else is, and they're making moves behind the scenes, which is causing this irregular heartbeat that might trickle into something that would lead to intensity, right? So let's do the dot-com bubble, for example. What is that? So this is just for example purposes. So dot-com bubble, back in 2008, prior to, there's a lot of people that are part of the boomer phase, right? Computers may have been something that they didn't see in our future and they probably thought was a fluke. So you see the computer companies increasing in value and the market goes to really high highs. And then you got the boomers that are looking at the situation and saying, man, I cannot see this happening. I don't understand why these computer companies are touching these outrageous numbers. So they pulling their investments, and then you start the snowball effect, right? As investments get pulled, the guy at the top doesn't want to have to be the guy that takes the biggest loss, so he starts selling. The guy in the middle wants to start selling. The guy who bought the bottom, he might start selling as well, causing an entirely new low, which creates a market crash. In the previous video, we talked about our competitors, right? We have the retail guys, the consumers, the institutions, right? Market makers, and then we have the algorithm. The algorithm's not our competitor, but it's the thing that keeps the heartbeat stable. So when the three, consumer, institution, and market makers, start to make moves that create volatility, it throws that heartbeat off a real irregular stage. So if we touch lower volatilities, oftentimes the algorithm will create false volatility to bring it back to the middle point, right? To keep the pace. That being said, in the dot-com bubble crisis, everyone got very emotional and sold off this entire fiasco, causing a new low on the market. Volatility increases, market drops, right? Because the more volatile something is, the more dangerous and unpredictable it may be. So a lot of hedge funds and market makers don't want to keep all of our investments in that portfolio because now they might risk a drop off in the market that they may not be able to cushion for us because they manage our money. So if you're not a regular trader and your portfolio, 401ks, IRAs, retirement funds, are invested into, let's say, a company like Charles Schwab or JP Morgan with one of your banks, these banks are going to want to sell off your portfolio if volatility goes too high. Because if the market starts to crash, they can't sell it for anything, which means your money is at risk. So if the big dogs start selling in order to sit on cash, then they're waiting for the market to find stability. And when stability comes, they can reinvest our money, make a larger profit on it, and just give us our guaranteed returns that they would potentially give us for our retirement. We can't touch it till we're 65 anyway. So doing this allows them to save their capital. So that's why when high volatility comes, they just want to take it out because there's no risk in sitting on cash. Because if the market goes down lower, they can just buy it for even cheaper. So you, being the guy trying to catch the bottom, will just keep getting dropped lower and lower and lower during those crises, which causes a lot of people from previous market crashes to have a mental or psychological trauma to market crashes. And maybe some of our, let's say, grandparents or parents might have experienced something like the Great Depression, or other financial crisis that put them into some really bad situations financially. So now they spread that rumor to you saying, hey, watch the stock market. It's very risky. It's very dangerous. But now, as we can see, looking at the regular market, it never really touches a new low. After each crisis, it always finds a way to get back to the all-time high. So that volatility, again, to tie this all back in, when the volatility increases, the market drops. So if we can reach high points of volatility, who gets the best discount? Us or the banks that can take out our portfolio, put it into cash, and wait for the smallest drop and make the biggest commissions? So it only makes sense psychologically to induce fear into the market when it reaches all-time highs because no one's going to want to sell it at that point. So we're going to need some kind of economic scares in order to have people wanting more cash instead of more assets. So if you start spreading rumors about Great Depressions, our grandparents and parents will give us advice of saying what? Hey, you have to get more cash. Make sure you go and buy gold bars and bottle caps. So that takes all the actual cash and assets out of real estate, right? Because you want to start selling your home to get cash. Maybe you'll take out loans to borrow money. Maybe you'll start selling your stocks to get more cash. But what does that do? It leaves all of your assets up for sale. And the guy who has the most money gets to buy it up because he doesn't care about having more cash because he has enough for himself and he's the guy that always wins. So with each economic crisis creates new billionaires, and new billionaires creates new market makers, and new market makers are going to create new strategies to cause a new crisis to force you out of your assets once again, and therefore taking up everything you own, forcing you into a corner of psychologically fear, and then taking advantage of you. So when we talk about this context in the manner of war, right, let's put this in the perspective of the far right. We are the enemy of another nation. How can we destroy this nation without necessarily causing bloodshed, right? We need to now use propaganda. If we can tell this other nation that their leadership is corrupt and fighting for the wrong things and get them to believe us, they might surrender before the war even starts. And that would save all of our people, and it would allow us to gain allies out of our enemies. And if we can do something like that, we'll take advantage of the leadership and acquire lots of assets. So that same play is being used against us, even in our own economy, because they are pushing volatility, which fear puts us in a bad position, making us want to have more cash, and they acquire more assets. So if you can see this correlation, the VIX is a really good tool to understand. So anything above that level 20, you should probably start questioning, is there something coming? And if it goes above 30, it's definitely something coming. As you can see, most of the events that we have on our chart here correlate to the same thing. So high boosts in volatility, big market crashes. So it's best if you sit on cash and wait for it to cool down.